Okay, I thought what I'd start with is our main job, the most important thing we do when we're going to assess anything is we want to get to know as quickly as possible. What do we do to screen out all the stuff that is not of interest so we can focus on the very few that we want to spend time on? And the first thing I do, and I'll have Mickey's input as well, but I go straight to the website. What's the layout? Is there enough? Is there information? Is it put on there intelligent? Is it current? Is it recent? Or is their presentation 3 years old? The news releases. If a company puts out a news release, I want to know, first off, the quick, easy one for anyone, non-technical, what this means. And then I want to see the maps, the sections, the details. If that's not in the news release or linked to it, they're not telling you what you need to know. And whether it's good or bad, what it tells you is for some reason, they're not telling you everything you need to know. Either it's bad news or they're incompetent. Is there an ability to speak to management? Can you call up and talk to someone about this? These small companies, they generally take your call. Maps and sections, historic data. So many of these projects that people are working on have been looked at once, twice, three, every bull market. Someone pulls them up, re-knees, and drills the same hole. So you want to see that data. And an example of a company that I think does a fantastic job presenting their data is Integra Gold with their deposit in Idaho. Go there, look at it. They've got sections, maps, videos. You can call the president. So anyway, that's my first screen. What you got to add to that, Mickey?
Well, your point's well taken there. If you are not at a conference or in a town like Vancouver where you can go and meet with the CEO or talk to the CEO virtually, I tend to avoid that. But the website's a good place to start. For me, and what you alluded to is we need to eliminate as many companies as quickly as we can. So being a geologist, where it really starts with me is the project. And what I'm looking for in the project, number one, the right commodity. For me, that's oftentimes gold or copper. It could be uranium, some other stuff. But in a relatively safe geopolitical jurisdiction. And then we get into the geology of it. And I'm always looking for major geologic structures, especially for gold deposits, where a big discovery can be made. And I did this when I was my 30 years of consulting as a consulting geologist. For me, it's more like 40 years in the business versus 35 for you. But what we've learned is you've got to go to the right project in the right geopolitical jurisdiction. And I think that's where you and I have an advantage for people that follow us is we have the geological knowledge and experience to assess that. I don't get fooled very many times on a bad project, especially if I go and visit it then. And I can give you examples of where I spent a lot of time working in copper oxide, and I can give you, or I could give you, I'm not going to give them to you specifically here, but they look good on paper, and you get there, and copper oxide, you got to mine it shallow, you got to open pit it, you got to heap leach it, and you get there, and it's an anticline, which means a domal sort of structure, and everything dips in to the mountain, which is 200 or 300 meters high. So unless I'd gone to northeast Mexico and visited the project, I wouldn't have known that.
Yeah, that's a good point. A lot of times what you see on the flip book is not what is actually in the ground. Many times I can think of quite a few times when the surface sampling looked pretty darn good for gold or a copper deposit, but what happened was it was a silicified unit, and so it was resistant, and that formed the dip slope of the hill. So all the sampling along that hill was quite good. But the vein itself, or the breccia, was maybe 2 meters thick. But it was, you know, a couple of 100 meters by a couple of 100 meters. And you could see that in the field one time, but also I saw that in some of the sections that they produced. This is a project in Peru where there was a canyon that cut across this. And for some reason, they hadn't sampled down into the canyon, which was a big red flag for me, because that is your third dimension. That's your drill hole without having to drill it. So that keyed into that's a problem. And I was right. It was a very thin unit. I remember another project I looked at in Mexico, great trench. It was like 49 meters of 5 grams, etc. Yet you looked at the photos they had, and this set on a little ridge between 2 major rivers that flowed into a reservoir. So it's not going to work, right? So you've got to look at those sorts of things as well. I'm sure you've come across a lot like that.
Yeah, so I'm just thinking one time after a show, and it was actually a Cambridge House show, that you and I went and visited a project, spur of the moment, in the Mojave Desert on the way to Las Vegas. And we go out, and these guys are doing rock sampling on the ridge line, which made sense, kind of a chip channel samples right on top of the ridge, and they're getting really good gold values, and it was a new discovery. And lo and behold, we went and looked at where their drill pads were laid out, and the holes they were going to drill didn't get within a couple of 100 meters of the projection of the ridge. So right away, do you remember that? It was after a Palm Springs conference.
Yeah, we were going to Vegas. It was in California too, which dang, red flag.
There's another red flag.
Red flag, yeah.
So I think what we really try to do, or I try to do, you know, there's however many of these companies, you need to eliminate 95% of them right off the bat, where then you can focus on that 5% and eliminate enough then that you buy about 2 out of 100. So that's historically the way I've operated. I don't think you want too many companies in your portfolio.
No, I keep it, I think if 20 is about the max that I want to keep in there. That's what I can follow in detail. And it also forces you to continually upgrade. If you find something you like, there's always going to be something in there that, oh man, I wish I didn't have that now. So just continue to upgrade. When I first started working for VRIC Rule, I'd never been involved in that side of the industry, but I'd look at people's portfolios and they'd have 50, 60, 80 companies in there. And you'd talk to those folks and they couldn't even remember why they bought them or who told them to buy them. Someone did. Probably some newsletter writer.
I know a newsletter writer had so many in his portfolio, and this is about when I started an analyst about 15 years ago. He hired me to go through and eliminate some of them because he had missed warrants in the money that he forgot he owned. He never exercised his in-the-money warrants. So it can happen to the pros too. But I historically have held probably more than 20, but I've never covered for the newsletter more than 10, which are kind of the top picks for what I consider lay investors. I got as high as 34, and if you've heard some of my talks lately, I'm trying to exit some of those bad companies, and I'm now down to about 18, which is much more comfortable.
Didn't you just say that your talk today that you'd sold or selling all of your junior companies?
I'm not selling all of them. I'm slowly extricating myself from this sector. So as I take profits or break evens or at the end of the year generate tax loss sales, and I'm taking that cash out of the market because I'm buying farmland and gold right now, farmland in the heartland, and I would love to come back willy-nilly in this sector. I personally think the bear market's not over and we've got a ways to go. Could also throw out there it's going to take a rising gold price on an extended time period to bring interest back into this sector?
I'm buying. I like it out there. I think the setup's good. It'll be bumpy, but I think the setup's good. Now's a good time to be very selectively leveraging into the very few companies out there that are doing good work on projects that have the potential to attract a major. And I think that's one other thing I've noticed. One thing I've learned a lot is so many of the companies that I visit or look at, even if they're successful, the deposit thereafter isn't important enough to be chasing. It's not big enough for a major to buy out. So what generally happens, not always, but what generally you see happening is, okay, they got the resource, they put out a pre-feasibility and then a study, and then they've got to raise money. Then they've got to do the metallurgy. Then they've got to do the technical studies, the engineering, et cetera, et cetera. And all that time, they're forced to raise money at generally lower and lower prices as you're diluted out of that discovery, which in reality, most of the time, you should have known it was not going to be big enough or important enough to attract a major. And that's what Joe Mazumder at Exploration and Insights and I really focus on. Does this project offer the potential of a major or any mining company coming in and buying it before they have to start buying yellow trucks? I don't want to get involved in yellow trucks.
I think your point's well taken once again. Generally what we look at as geologists and 35 to 40 years experience in the field is the potential for world-class deposits. And because folks, 1 million ounces in the ground with no potential to the upside, and there's a lot of deposits like that out there, is not going to attract any significant company. So your merger and acquisition exit strategy is right out the door right then. Would you agree with that?
Yeah, definitely. That's sort of a death knell. And then there's other folks like to buy on that low part, the whole engineering and the down dip, the Lassonde curve for the ride up. And that's fine if that's the space you want to be in. And I think it's a good spot to be. It's not really my focus per se. But how many companies you reckon out there are going to end up with a world-class deposit? Or a tier 1 deposit anyway? One, okay.
Yeah, out here, I'd say you pick your 2 and 100, and if one of those works, then you make windfall profits. So that's kind of the goal. You can't hit on all of them here. But, most of the companies out here, and I've pulled this saying out for quite some time, they're really mining the stock market. They have no intention of ever mining deposit. That's okay, because a lot of them aren't miners. Hell, we're not miners. I don't want to be a miner. I'm an explorationist. But you want to make sure that the management has skin in the game. They are aligned with the shareholders, you being a shareholder, they're shareholders. So, and you look at insider buying and selling. If they do a private placement, you want to see them buying just as you are. It's a red flag when people are selling, insiders. That information's all available on SEDI.com, SEDI.com. Per company for every insider, as long as that company's existed. A lot of us, and I'm one of the people that sometimes I forget to check on SEDI on a regular basis, but I would encourage everybody to do that. It's easy to do.
I'd say that quote I threw up there from George Graham Rice from 1906 is appropriate right about here. Now, although maybe only, I don't know, let's be generous, 5 companies out there are going to find deposits that are going to be bought out or work really well. I would say a lot more of them are going to come across some nice looking initial results that are going to take the stock price up. And this is where I've made most of my money, a lot of my money anyway, is catching those, like this looks good. The results keep coming in. It's proving my thesis, looking good, but then something's wrong. If you can catch that fatal flaw up here before the rest of the market does, you can make really good money riding it up and getting out before the metallurgy turns bad, or there's a demonstration, your roadblock, etc., or whatever steps in. So I think you can still make money on someone that eventually does not find a major deposit. You've just got to follow the results and make sure it matches your theses.
The other thing I would add is don't be greedy. One of the most famous entrepreneurs, venture capitalists of the 20th century, early 20th century, Bernard Baruch, he made his fortune. He's an American, but he made a significant portion of his fortune in the early gold fields of Ontario and British Columbia. And he famously said, "I made all my money by selling too soon." So there's nothing wrong with taking profits. Don't get greedy, folks. You got good profits. At least lock in where you take all your money off the table. If it doubles, sell half. Then you're playing with house money. You're playing with other people's money. Hell, if I'm doing it, I might even be playing with your money at that particular time. So don't be afraid to sell. It's a lot easier to sell on the uptick than it is ever to sell on the downtick, because you keep thinking, oh, it'll go up there again. Most of the time, it doesn't.
I'd agree. My philosophy, one way or another, is if the thesis breaks, I'm out. I'm not. If my investment thesis changes to hope, I've lost my money. Let's throw this open to any audience questions. The question is, normal people don't get to go to sites and look at the projects, and that's true.
That's why you follow newsletter writers like us, who are geologists. Our two newsletters, Mercenary Geologist, .com and Exploration Insights. We are the three geologists, newsletter writers in the business. And Brent and I'll just tell a little anecdote here. Brent and I both started our businesses in April of 2008 during the global economic crisis. So we've been doing this for, nearly 15 years as newsletter writers. Pick good newsletter writers who have track records of success, and shortcut your due diligence by depending on them to make good recommendations for you.
Yeah, I agree. I think it helps to have someone who knows the industry you can talk to about these things. So
then you latch on to the geologist newsletter writer, someone relatively unbiased. Maybe it's a rely on somebody else, and there's a leap of faith there. You got to depend that he's not conflict and he's telling you straight. But I think it's doable. And I think I'm going to be brief here because we're out of time. I think another thing that lay speculators don't do is call up the company and with a list of questions and be persistent, and at some point you'll get to talk to the CEO. And I'm not going to disparage IR people, but they're there to promote the company. You need to be able to talk to CEOs. That's the beauty about these shows, is the CEOs are on the floor. Good point. And just the last point I want to make, if a person can't explain to you what they're doing, why they're doing it, how much it's going to cost, what they anticipate to happen, if they don't know the answers to that, it's probably not worth giving them any money. So with that, thank you all. I appreciate you sitting through it. I hope it was useful. And Mickey and I will be around, and all the best luck this year. Thanks a lot.